Welcome to Got Invention Radio. I'm your host, Brian Freed, and tonight we have Nicholas Orlando, otherwise known as Nick Orlando, and he is going to help us. He's a tax consultant. He's also an accountant. I'm sure there's a few other titles that he has with the three-letter acronyms after his name, which he'll tell us. But there's so many different parts of the invention process that we go through, and hopefully it leads to success. But at the end of the day, what is tax deductible and what's not? And I always hear the question of, Brian, when should I actually incorporate? Do I need a corporation? Should I file as a S Corp, a C Corp, a sole proprietor, self-employed? There's all these things. Well, you know what? I figured I'd bring the tax man on. Nick Orlando, welcome to the show.
Thank you, Brian. Thank you very much.
So, Nick, tell us about yourself and what do you do and how you help small businesses and entrepreneurs, and I'm sure you've dealt with plenty of inventors as well.
Well, primarily my main focus is on small to mid-sized businesses. We do everything from tax planning, income tax preparation, budgeting, forecasting, things of that nature, all general bookkeeping. And, I am QuickBooks certified. I'm certified in Xero software, which is new software that came out in the last year or so. And I keep looking for different alternatives and automation processes to help the small to mid-sized.
Okay. Well, that's interesting. So, Nick, we always look at when we come up with an idea that we're starting a business. So, as we're going through the process, if we could get right to it, Nick, the first thing that most of us do is what we call a patent search. And then we end up doing some drawings. We have a professional make some drawings for us. And it may not be in this particular order for the most part.
Right.
These are the part of the invention process. Then we're making prototypes, whether we pay somebody with machinery to do it or we're the ones that are going to Home Depot buying all the parts and electronics or whatever our inventions are. And then we may end up going to back to a patent attorney for more intellectual property, and we may get a trademark, and we may go to trade shows, and we have to travel, and we have business meetings and expenses and lunches and dinners. Tell us what to do, Nick.
Well, first thing you should do is make sure you keep very accurate records. And one thing I want to bring up, because what you guys do that a little bit more creative than the average Joe, you incur a lot of expenses, especially in the first year that you're in business, because of all of what you just mentioned. And getting back to the term of what type of entity should one choose, I just want to touch base on that first of all, because it's going to be different for different people based on your background and based on the type of business you're getting into. But the number one thing with inventors and entrepreneurs is basically with the amount of money that you're spending, it's very common in the first 1 to 2 to 3 years, you're going to incur some substantial losses. Now, doing so as a sole proprietor, which is technically an individual who owns an unincorporated business, you're going to show those losses on your individual return on what's called a Schedule C. Now, by all accounts, and anyone could research this, anyone filing a Schedule C, especially where there's substantial losses, you're 10 times more likely to get audited by the IRS than if you have a corporate structure. And that's just the way it is. It's because you're combining all of these detail on your personal return. And it's like anything else. The more you give them to look at, the more they're going to look at it. Okay? So that's the first thing I want to just stress here. Whereas somebody in a different type of business, maybe is not going to incur such large losses or losses at all, I may say, you know what, operate as a sole proprietor for a year or two, and let's see where it goes. And then just taking it from there, yep. I'll tell you about, very briefly about the different types of corporations. As you know, you have a limited liability corporation, which is a flexible form of business. It has elements of both a partnership and a corporation, and it's also created under state laws. Everyone, I think, is pretty much familiar with a partnership, which is a business carried on by 2 or more individuals, wherein each may contribute funds or assets or skills or share in the profits or losses of the business. Then you'll have a C and an S corporation. Now, the primary difference between a C and an S corporation is an S corporation is what they call a pass-through entity, whereas the profit or loss of that corporation passes through to the shareholders, and the income or loss is claimed on the individual shareholders' tax returns and gets affected by their tax rate. Because as a C corporation, a lot of people complain that with the C corporation you have double taxation, meaning the corporation pays a separate tax on its earnings, and when the shareholders take money out of the corporation, they are taxed again. All right, there are certain ways around that, but that's the primary difference between the two. And there are a lot of situations where one may be more beneficial than the other, and again, that has to do with reviewing a potential client's whole background and situation.
Okay.
Nick, again, comparing an S and an LLC, the tax treatment of both are very similar, where they are both pass-through entities, like I previously mentioned. The main difference with an LLC, especially here in New York, is that the LLC requires that you do a filing in a newspaper, which is dictated by the court, all right, or the county clerk's office, and that makes the LLC or the generation formation of an LLC more expensive, because you could run just $1,000 or more just for the publication that's required. Now, another difference between an LLC and an S corp is basically that an LLC, especially as a managing or general member, any income derived from that LLC is treated as self-employment income, where whatever money you take out, you have to pay self-employment tax out. As an S corporation, you may have a salary, and you'll pay self-employment tax on that salary, but there may be a residual at the end where there's a small profit. Now, that profit you could take out in the form of a dividend, and that just gets taxed at the normal tax rate that you're at, and it doesn't include any self-employment tax. So it could be a little bit cheaper that way to go with an S corporation as opposed to an LLC.
Okay. Nick, that is a lot of information very quickly, and we appreciate it. And there are inventors that may have to, thank goodness this is archived, because that's some valuable information that they may want to hear once or twice. But really, Nick, there's no right or wrong way to tell somebody what the right corporation is or the way to file, because everybody's situations are different, right?
Yeah, exactly right.
So they really need to consult with a tax professional to make sure and see what really makes sense for them. But Nick, I'll tell you, when I first started with my invention journey, I seem to have been opening up S corporations for every corporation, for every product that I came up with. And I realized that later on that I would be suffering consequences of paying taxes on products that I kind of just left to dry. And I started to realize that you form one corporation and then you put all these activities in there, and then if there is some kind of activity, you can always add another one if there is some kind of success to it. What do you think about that, Nick?
Well, again, it depends on exactly what you're doing. I mean, I have certain clients that let's look in construction. I have, and it's also a matter of basically setting it up, not only what's feasible for successful business purposes, but also to protect your liability of your assets and limit your liability. I have a few construction clients that also invest heavily in equipment. So we'll set up a separate equipment company for them, which will hold all the assets that they're going to use in their trade or business, and just run the regular revenue that's generated from their construction projects through the construction corporation. So what's happened, in the event of something happening, on the construction site, you're not risking all the heavy-duty equipment you've got in the equipment company.
Okay. Nick,
per se.
Okay. So I come up with this idea, and let's say I own a home and I have some assets, and I want to protect myself, and I end up starting to put some money into this invention, and I bring it out to market, and I don't have product liability insurance, and somebody, God forbid, gets hurt or whatever it is, and now they want to come after me. I have no corporation or no nothing at this point. What happens to me then?
You're at risk. I mean, you could basically lose everything at that point.
Okay. So now we're talking about layering the risk connected to you directly. So now we have the corporations. That's the purpose of these corporations and different ways to file.
Right, because all you have at risk with the corporation are the corporation's assets. The only way anyone is going to really be able to pierce that corporate veil is if they could prove, fraudulent and deliberate negligence on your part. It's something that you did at will.
Okay.
To hurt or harm another individual.
Okay, so let's keep this really simple then, because you explained it quite detailed earlier. So now I want to layer I want to protect myself. So why would I choose a C corporation, and why would I choose an S corporation?
Okay. Basically, a C corporation is technically easier if you really think your product's going to hit and you're going to take it, you want to go public.
Okay.
Because there's a limit in terms of the number of shareholders and everything else with an S corporation. S corporations were initially established and suited for smaller companies, let's say doing $10 million or less. And C corporations also allow you to the benefit of, it's just easier to have set up employee benefit plans like insurance, health insurance plans, and things of that nature. Whereas with the S corporation, you could do it for your employees, but if you're more than a 5% shareholder of an S corporation, you cannot get a deduction of having them pay your medical insurance.
Okay.
And certain other fringe benefits. That you'll have to include as income just as on your W-2 statement, and then you'd be allowed certain deductions on your individual return.
Okay. So, Nick, let's say I'm exploring and I'm going through the options. I know that it costs money to incorporate, plus you also have the yearly taxes and so forth. But all I'm really spending, well, it's not all, but during my process of investigation to see if my idea makes sense or not, I'm starting to put money into some patent searches and prototypes and, maybe traveling around here and there. Do I have to have a corporation to have those activities being written off?
No, you don't have to have a corporation, but as I mentioned earlier, it's just a better way of doing it to avoid the scrutiny of the Internal Revenue Service. Again, a corporation, I'm not saying they don't get audited. The IRS and New York State, et cetera, they're increasing their audit efforts all over. But as it stands right now, corporations are less likely to be audited than you would have for a sole proprietorship.
Okay, but I
now,
didn't even file
in the event of let me just, one point, C corporations. If you have losses in a C corporation in the early years, you could carry those losses forward and backwards to offset income in future years or subsequent years. An S corporation, you can't necessarily do that because any losses you have are passing through to your individual tax return, and you're taking them in the current year.
Okay. What do you think is the threshold, Nick? I mean, what's the point where, I guess a sole proprietor, you don't have to. Do you have to file? Here, my name is Brian Freed. I came up with this idea. I'm not starting any corporations. I want to just work on my idea. I'll keep some records and track it. And what is the point? Like, how much should I spend on my research and development side before I really decide to file for a corporation? Because I'm going to have to pay taxes and I'm going to write stuff off and all that. But when is that point? When do you think the threshold is?
That really depends. And, I know a lot of people don't like that answer. It depends, but it depends on the overall situation, the personal financial situation of the people that are involved with this. Depending on the more that you have to protect, I just tend, in that type of business, would say, if this is what you intend to do, form a corporation from the start. It's not really a big expense. You could do it between $400 and $500, and it's going to alleviate a lot of headaches. Because, again, withstanding nothing else, let's say you incur these losses, and maybe it's only $5,000 or $10,000, and it's on a return. You're not showing any income because you haven't sold anything yet. So what happens is now the IRS comes in, and the IRS wants to audit your return. You could have pristine records, and you did nothing wrong. Okay, but the psychological trauma of that, and just you're going to spend at least $1,000 in representation fees. plus the hassle of going through their inquiries and things. And to me, it's not worth it.
Okay.
And I will discuss